Well, we made it to Friday. Thanks for joining us here. Mark Oppold got a little frog here today, and so we're going to be leaning on our analysts here to take us through the day. And they're going to start right out here with Brian Hoops, great friend from Springfield, Missouri. And Brian, we'll give it over to you to check this overnight trade. Everything higher. Get your thoughts on that.
Hey, good morning, Mark. I hope you feel better.
Oh, I feel good.
Yeah, you don't sound so good.
No, thank you.
It was a really wild overnight session as we had Israel attack Iran, and that spiked the grain markets higher. It spiked crude oil sharply higher. At one point, we were 4% higher. But look at the corn. May was up 2 3/4. July up same 2 3/4. Dees 2 1/4 higher. But you look at the range there. It was about a 6-cent range. We settled right in the middle of it, and we saw even more dramatic moves in soybeans and wheat. If we want to look at the soybean market overnight, we were 2 cents higher in that May contract. Couple in the July and November up 3.5. We settled about 7 cents off our highs there and well off of our lows. And market feels like it's trying to build a little premium going into the weekend. And certainly the attacks overnight helped. But wheat was the big mover. We had a 20-cent range at one point in time. Wheat was 20 cents higher. A high in the May contract at 5.58 3/4. We settled 16 1/4 off of that, 5 1/4 cents higher. July was up 5.5. Dees up 3 3/4. Kansas City didn't quite get the same bump that we saw there. And I'm a little surprised because it's really dry in that hard red wheat belt. And we were supposed to have rains this week. We didn't get any rains at all. May was down 1/4. The new crop was up a penny. Dees was up 1 1/4, and just didn't see that, that strength into the morning hours. We saw Minneapolis up about a nickel in the May contract. New crop September up 5. And you saw some big moves in those deferred contracts. There is some delays starting to develop in that spring wheat belt. It's 20 degrees in Montana, for example. Very windy, soils are drying out, and they're just not able to get in the fields at any time here. Because of those conditions. So we had private export sale announcements this morning. 216,000 corn sold to Mexico and 121,000 beans sold for delivery to unknown destinations. And of those totals, the vast majority are for that 24-25 marketing season. Most of it's not going to really affect the markets this much, but it was, as I said, it was a wild ride in crude. If you can pull up a crude oil board there, we at one point were trading over $85 in the June contract. There it is, 85.64, and you can see we're $4 off of that high overnight. And we were trading crude oil about 9 o'clock last night. I was on the phone with clients, and it was a pretty wild ride when all this was going down.
Yeah, let's talk to not only crude oil, but all the grains you mentioned well off their highs. What does that bode? How does that tell you what might be going on today? We maybe a spike high, and we might even be lower today?
Well, I wouldn't be surprised. The crude oil is trading lower. It's, 64 points lower. The stock market was just getting slammed at one point last night. Now it's come back to near unchanged. So these grains could be back to near unchanged in early dealings this morning. It does feel like maybe we've pushed the grain markets lower into midweek, and going into the weekend, maybe we put a little bit of premium back into it. But the technical damage is being done in those grain charts, and it seems like rallies will be sold in those grain markets.
Make sure we cover cotton here. Mixed trade there overnight.
Yeah, and kind of lackadaisical trade. The May contract a little bit higher, December up just slightly, but very limited trade. You can see the high and low, less than $1 range in that December contract. Just not the volatility in cotton that we saw in some of the grains or these outside markets. And
a chance to check this gold market here as well, and all the events in the Middle East. But May down over $8.50.
Yeah, that's a cause of what happened with the U.S. dollar index, which is starting to trade lower. So maybe gold and silver start to find some interest. But, they kind of spiked high maybe a week and a half ago. And since that time, they've kind of gone flat. They're at very high price levels and not finding a lot of new, fresh buying interest at these price levels. So they're left with more of a choppy type trading affair. Yeah, many thought it might be,
May might be going up to $26, $27 an ounce. But it might be a little harder, said than done.
Yeah, we might have to have more of a correction first, get some of the longs out of the market and then take another run back to those highs.
Very good. Thanks for your time here. We're not going to let you go yet. We'll come back and we'll check the livestock trade. Brian Hoops, Springfield, Missouri. Be right back after this. And we are 10 minutes away from opening the grain and the livestock trade. Mark Oppold here on a Friday. And it's me. It doesn't sound like me, but everything feel good. But the old allergies or the pollen is taking its toll here at the end of the week. So we're going to hand it over to Brian Hoops here. I'm glad he is here from Midwest Market Solutions in Springfield. Let's take a look at the cattle trade ahead of that on-feed report and how it closed yesterday and your thoughts going into the day today.
Yeah, okay, so the on-feed report does come out this afternoon, 2 o'clock Central Time, and the estimates are looking for about 102%, 2% larger than a year ago, but placements maybe 92, 93%, so much less cattle being placed this month compared to last several months and compared to year ago levels. Now, the steer weights that came out yesterday, they're still 27 pounds heavier than a year ago, so you look at 2% more cattle on feed combined with heavier cattle being fed, that creates more supply. And because the packer margins are negative, they're cutting those kills down, and we're just not able to get through these cattle. And so our marketing effort in this report is probably going to be at least 10%, maybe even more, less than a year ago. So we've had really choppy trade. April cattle up 27 yesterday, June up a nickel, and some of those back months, looking at those smaller placement levels, that's where we're seeing the strength. August up 75, October up $1, these nearly $1 higher, and those back months settling near the highs of the day. So we may see more of this type of trade because we haven't seen any cash trade yet. We may not until right around that cattle on feed report time.
Wow.
We may just chop around in here with this futures market, trying to add a little premium, anticipating a bullish placement number and waiting for that cash trade to develop.
We've been talking about that placement figure all week, but marketing, as you mentioned, maybe down as much as 10%. That, to me, has to be a number to deal with.
Yeah, and I understand the feedlots, I understand the producers, they wanting to sell at higher money. They don't want to take a little bit cheaper numbers in here, but still the fundamentals are what they are. Heavier carcass weights combined with bigger supplies, it doesn't bode well when you hold those animals back and try and feed them out to even heavier levels. So we got a little boost in feeder cattle yesterday from lower corn prices. There's still good demand at the sale barn levels, and the feeder cattle index is still, for the most part, creeping higher on a week-to-week basis. April was up $1.17, May up $2.27 yesterday, August up $2.17, and those feeder cattle futures looking at lower placements, thinking that maybe we need to keep some good premium in those prices, anticipating what's going to happen in the pasture conditions, what's grass is available into the summer months.
And like the live cattle, the feeder cattle adding a little bit of value in those deferred contracts in the third and fourth quarter.
They certainly are, and I think they want to keep that premium out there. You can see, there's a $13 premium from September versus the May contract. So that, you go out in that third quarter, the fourth quarter, that's where that real rich premium lies, and probably the best hedging opportunities. All
right, that leaves us looking at the lean hog complex, a little bit lower, but holding on to a lot of the earlier advance this week.
Yeah, they have. They're just consolidating right now. We had the big moves a week and a half ago on a Wednesday, a big reversal, and then into Friday of last week, some downside follow through. Now, basically this entire week, they've chopped around, 20 higher, 20 lower. Yesterday, you look at the June contract, virtually unchanged. July up a nickel. They're going nowhere fast, and that's a sign of a consolidation type market.
Very good. Brian, thanks for your time this morning. And just take the rest of the day off, will you?
Hope you feel better.
You bailed me out here so far here today, and I really appreciate that. Brian Hoops, Springfield, Missouri, Midwest Market Solutions, and maybe I'll do a little sign language.
Exactly.
You said, Mark, don't talk to me.
Go get some tea, go get some honey, Mark. Thank you so much.